CME Group launched Micro E-mini Futures Contracts. Discover how a smaller Micro E-mini Futures Contract opens the world to greater trading possibilities.
Welcome to Market Movers. I'm Jim Urio with Scott Martin.
Hi, Jim.
So in the stock world, in risk assets, let's say, something has clearly changed. What is it? Is it all about the trade rhetoric? Is it all about the lack of an agreement?
It's trade rhetoric, Jim. It's growth expectations. It's inflation that is still non-existent in the sense of I think that's putting into question, are we really going to grow this year? Is the Fed actually going to come back in and maybe listen to the market, Jim, and cut rates again, my goodness?
Okay, what would change the weakness in the stock market if Trump came out and said, everything's been settled? If the Fed came out and said we are actually going to lower rates, would risk assets soar?
Well, that's a great question, Jim. And I think the reality is this. There's a lot of things that could change the rhetoric right now. I mean, you're right. It could be the Fed. It could be a deal with China. I mean, USMCA is still on the table, believe it or not. It needs to be passed. So in my opinion, there's a lot of things that could happen in a good way that could help support the S&P here, as bad as things look right now.
Okay, now before we dive into our trade discussion, I'd like to point out these are examples, not recommendation or advice. When we price these out, the E-mini contract was trading about, it's the June, is trading about 27.80. Scott?
Yeah, so Jim, 27.80 after a really volatile day.
Right.
And I'm kind of disappointed in the action at 27.80 just because I thought, and we talked about this on a previous MM segment, 2800 looked like a good line in the sand, both for support.
Twice it worked.
Twice.
Yeah.
And then maybe even resistance going up here if we do recover, as I mentioned, because of some of those things coming through. So today, we're going to see if we can have some fun with the 2800 level. As an example, Jim, specifically looking at buying the week 1 Wednesday, 2800, 2825 call spread for 8 ticks. This trade expires June 5th. It's Wednesday, June 5th. Risk 400 to make a potential 850. The underlying 2780, as you mentioned. Here's the deal. I think 2800 is really going to be in play again as far as how the market is going to take either good or bad news. So therefore, yes, that could definitely look as maybe resistance going forward. But if it does get up there and break that 2800, I believe that call spread is a nice way to express some bullish behavior.
When you explain it, I actually like it because I think that 2800 is again the line in the sand now. And I expect a little weakness once we've broken through that, mostly from a technical standpoint. It looks to me like we're going down to about 27, 25. But I like the way you're putting it. An 8, risking 8 to make a grand total 25
only
ticks.
20 ticks away.
Okay, that actually makes some sense to me despite the fact that I'm the other way. Now, I'm doing something a little bit different. And this kind of thing I do all the time, but I've been reluctant because it seems confusing at first and it's not. What I actually did, but my example is buying the week 1 Wednesday that goes off June 5th, the 2760, 2710, 2680. You call it a put fly 1 by 3 by 3, but what you're actually doing is buying one of those 2760 puts and selling 3 of the 2710, 2680 put spreads to finance. And I do this kind of thing all the time. The max risk is 1375 to make a max 2125, but to lose that 1375, that means on expiration it's going to settle at that lower strike. Because anything below it, you start to make money again. Anything above it, you start to make money.
Which is nice flexibility. Right. And I love it when you talk to me like this about
good.
These 1 by 3s by 3s.
Does it make sense though?
Well, it does in the sense of, like you said, there's a lot of ways that this can work out, in my opinion. And given that we're seeing a lot of volatility here, the market is trading on a lot of headline news. Headline risk is definitely alive and well. I believe that this is a nice way to express at least some of those possibilities.
Now, something I've been doing the whole time here, because I do trades like this all the time, and the one thing that happens too is if you take them near expiration and then that put gains a lot of delta as it's moving through it, I use the micros to hedge my delta as it changes. Have you been doing that as well?
I have, and I think the call spread I talked about a second ago could have some micro potential hedging to it as well. If we do get that run up to 2800, maybe it does get rejected, the ES at 2800, maybe you can hedge that out with some micro exposure if you just want to take a little off.
Just did it today. Had one of these structures on that was gaining too much delta. I never really thought that would be what the micros I use them for, and I use them for them every day.
You're doing it, Jim.
Yeah. Thank you for joining us on Market Movers. I'm Jim Urio, where we are helping to make you a better trader.